Hello traders. Okay, in this video, most of you have been asking me because I get so many questions, I get so many texts online or emails. People have been asking me, how do you differentiate between wave 5 and wave 2, and then at what point do you really know, or can you tell when the impulsive wave is just ending? So that is what I want to answer today. And before I do that, kindly subscribe if you haven't yet subscribed. Turn on the notification bell on so that you don't get to miss out on these perfect episodes, these great episodes that I keep posting. Again, if you are watching this immediately when I post it, you are going to get more benefit other than just knowing how to tackle Elliott Wave analysis. You are going to get full benefit of how to handle the current market. This is current market in terms of euro dollar pair. So looking at this, the most important thing that I need to show you is you have to be a great thinker. When you want to really be an Elliott Wave, a practitioner, you have to think. You have to think outside the box for you to get the perfect point on Elliott Wave analysis. So the reason as to why I'm saying you have to be a perfect thinker, or rather a great thinker, is because most of these things you are supposed to see them, or rather some things are going to be so obvious to you after you've developed that open-mindedness. So without talking too much, if you look at this currency, that is euro dollar, the most important thing that I am considering when looking at euro dollar is the impulsive wave. Other than just the basic knowledge of Elliott Wave analysis, we have the impulsive wave, that is wave 1, and then we have wave 2, which ended at that point, then wave 3, which was more of a bit longer, and then we had wave 4. We had wave 4 right at this point. So let me show you. I'm saying this is wave 1, wave 2, wave 3 right at this point, and then wave 4, which ended right at this point, and then finally wave 5. This is the most important thing. This is the most important thing. Remember, let me talk about wave 2 first. Wave 2 is a running ABC wave, is a running correctional wave. What I mean by running correctional wave is, if you look at this keenly, you can see that we have point A, point B, and then finally point C, which is above point A. Most of you are well conversant with the correctional wave, that is wave A, wave B, wave C. But again, this is not the case. If you look at this type of structure, or in terms of an uptrend, most of you are conversant with this type of wave. That is wave A, B, and then C. So if you look at this is different from this, because if you look at this is not a running wave. This is not a running correctional wave. This is a zigzag wave, or rather a perfect correctional wave. It is not the same as this correctional wave. In this case, we have wave A, then we have wave B, and then we have wave C. This is different from this. So this is something you really need to get the difference when you want to trade Elliott Wave analysis. That is the simple part on wave 2. Again, this type of correction, always it can appear. There is no problem when it appears in wave 2. There is totally no problem when you find it appearing in wave 2. And then when I talk of wave 4, in this case I'm talking about I'm talking about rectangle. Not rectangle, sorry, but triangle. I'm talking about triangle pattern. Again, if you watched most of my videos, you know very well that I like to see wave 4, a triangle on wave 4, than a triangle in wave 2. When you see a triangle in wave 2, that means it is likely not a wave 2. There is a high chance it can be a wave B or any other corrective pattern, but not a wave 4. Or rather, I mean not a wave 2. So looking at this as a wave 4, it gives us a perfect setup that the next wave, when market breaks out of this correctional wave 4 triangle, then the next wave pattern is the climax of the impulsive wave, that is wave 5. So looking at this as wave 4, the best way to actually number your wave, that is, we have wave 1, wave A, B, C, D, and then finally wave E, right at that point. So this is the perfect correction of wave, that is wave 4. So after wave 4, we have wave 5, which is the climax of wave of the impulsive, or the first impulsive wave. Again, the climax being that wave 4 can be equal to wave 1. If you look at this, it is more of wave 4 equaling wave 5 equaling, or rather it is approximately equal to wave 1. Or again, we can have other ways to measure, or other ways to give us a target on wave 4, on wave 5, the end of wave 5, because that is something very important. If you watch most of my videos, you will tend to realize what I'm talking about. So after the impulsive wave 5, that is wave 1, 2, 3, 4, 5, impulsive wave 1 through 5, we have the corrective wave. And the corrective wave we are looking at in this case is wave A, B, C. So if you look at this, we have wave A, wave B. We still expect a wave C. We still expect a wave C. So this is now the point where, this is where we have the point of thinking outside the box. If you want to really be an Elliott Wave enthusiast, you have to think outside the box. You have to think outside the box. So this is still also in terms of daily time frame. This is still in terms of a daily time frame, and in terms of a daily time frame, we have a good pattern that is forming. Wave B formed a good bearish flag pattern, and we just broke out of this flag pattern right at this point. That was on Tuesday, 16th of January 2024. So after this breakout, we've seen that market has been making a certain pattern which is really not clear in daily time frame. So being that now I'm interested in this part, I'm interested in trading the correctional part of the impulsive wave, that is wave 1 through 5, ending of wave 1 through 5, which is the beginning of the correctional pattern, that is wave ABC, or any other correctional pattern. Then this now becomes my point of interest. This becomes my point of interest, and so should you. So if you narrow down to 4-hour time frame, we have what you can see right at this point. So in terms of a 4-hour time frame, remember we are still looking at wave C. We are still looking at wave C in terms of the longer term perspective. Again, if you look at this market, anyone can tell that this market is still in a downtrend. Anyone can tell that this market is still in a downtrend. So it is not still right to say that this market is reversing direction, or is planning, or rather is primed to reverse direction. So the first point that you can also use to trade this currency is the moment market was right at this point, this is a move that if you are in my VIP, you probably caught this move. You probably caught this move if you are in my VIP membership. Because from this point, around this area, we got a good move on bearish side. That was aside from the fact that we had a breakout of the major trend line, that is wave B bearish flag. So what we have right now, where the market is at currently, as you can see, this is a live market. So where we are currently, what I'm still looking at is a continuation of this downtrend, So the question becomes, at what point is it best to get in on this market, that is Euro USD. So the best point to get in on this market is to look at it in a broader perspective. Again, most of you are conversant with ending diagonals and leading diagonals. Remember, ending diagonals and leading diagonals, they are diverging at a certain point. But then if you look at this, we have more of a diagonal diverging, but then the leading diagonals and ending diagonals, the ones that most of Elliott Wave enthusiasts or practitioners are comfortable with, is the converging diagonals. So if you look at this, we have a diverging diagonal, which even if you don't know how to number these waves or these points, you can just say this is point 1, point 3, and then we have point 5 right at this point, or the point rule, the three-point rule. So if you look at this, again, considering the fact that this market is still in a downtrend, the most significant point that this market could touch before reversing is either this market could get to the supply zone before reversing. If it gets to the supply zone, that doesn't mean that this market has changed direction. We are still looking at it in terms of a bearish, because remember, on a higher time frame, or rather on a long-term perspective, we are looking at, this is actually the time when around the time when market just broke out of this trend line, this upper trend line. So from when you look at it in terms of market breaking out of this zone, which is most unlikely, the reason as to why I'm saying it is most unlikely, because we've seen this market just reject this trend line, around this trend line. At the same time, we are seeing market still within the pattern, or rather the consolidation, the bearish flag pattern. This is more of a correctional pattern. So there is a high chance that this market will likely just break to the bottom. If it breaks to the bottom, the best thing is to look for bearish signal. The best thing is to look for bearish setup. I consider this a double A plus setup. I always have a triple A, double A, and then a A setup. So this is a good example of a double A setup. The reason as to why it is a double A setup is because market is really not at the top and not really at the bottom. We are still continuing with the direction of the trend. So this is the reason as to why I'm looking at it as a double A setup. So this is it on Euro USD and how to trade diverging patterns, diagonal patterns. At the same time, how to be objective, how to be objective in when you're trading Elliott Wave analysis, or when you're doing Elliott Wave analysis. I believe this just this video will help you determine a lot. It will open your mind on a lot of things. If you have any question also you consider you'd like me to answer, I'll answer it. Just comment down below, I'll gladly answer your question. If you don't have any question and you enjoy this content, kindly give it a thumbs up, and see you in the next episode, and have a successful week ahead.